Hello, everyone. Thanks for joining in on a short webinar we've created to deal with the tax rate bylaw in municipalities in Alberta. My name's Angela Bilski. I'm an advisor with the Capacity and Advisory branch of Municipal Affairs. And with me is Jordan Velaston. He's a financial advisor with me in the same unit. So we're just happy to present information on the tax rate bylaw, which a lot of you folks may be looking at in the next little while here. So not only is it a legislative requirement for each municipal council in Alberta to pass a property tax bylaw annually, generating revenue to fund municipal operations is obviously hugely critical for the sustainability of municipalities. And a large part of this revenue will come from taxation. So there's several types of different taxes the MGA allows municipalities to impose, including business tax, local improvement tax, special tax, community aggregate payment levy, business improvement area tax, well drilling equipment tax, clean energy improvement tax. But today we're going to focus on usually the most significant source of revenue, which is property tax. And with tax season fast approaching, we thought this would be the perfect time to dedicate a webinar to this important bylaw. So this is an outline of what our session will look like over the next hour or so. And our primary goal today is to give you a good understanding of the legislative requirements involved in the tax rate bylaw and highlight some important considerations you need to keep in mind when developing your bylaw and preparing to send out your tax notices. And to give you some practice with understanding which numbers need to go where in your bylaw, Jordan will be walking you through the case study accompanying this webinar, which is also available on our training webpage. If you have any questions about the information we will be presenting or the case study, you're most welcome to give us a call or send an email, and we'll provide that contact information at the very end of the webinar. So to provide some context for where we are in the tax cycle in March of 2023, this is the view from 30,000 feet of how the process flows. So the annual budget is an absolutely critical first step that determines which services will be provided to residents and at what levels, which ultimately determines the tax rates necessary to fund them. If we want to back up even further, the budget is actually informed by the municipality's strategic plan. So the operating and capital budgets were required to be passed before January 1st of the current year, but often an interim budget is done at that time with the final budget approved by council early in the year after they have been given more information on assessment values and provincial grant funding levels. Once council determines the amount of money needed to operate their municipality, other known sources of revenue such as permits, licenses, user fees, and grants are subtracted, and the remainder is the amount of money the municipality needs to raise through property taxes in order to provide services and fund capital expenses for the year. This revenue requirement is then used to calculate the tax rate. The annual tax rate bylaw required by Section 353 gives the municipality authority to impose and collect property taxes. But it's important to keep in mind that the terms assessment and taxation are not interchangeable. Assessment is the process of estimating a dollar value on a property for taxation purposes, whereas taxation is the process of applying a tax rate to a property's assessed value to determine the taxes payable by the owner of that property. So let's take a closer look at how assessment fits into how tax rates are calculated. So the tax rate is the percentage of assessed value at which each property in a municipality is taxed. And Section 355 sets out that the revenue requirement determined by the budget is divided by the assessment base, which is the total value of all assessed properties in the municipality determined on the fixed valuation date of July 1st of the previous year. So if you look at the formula on the slide, the budget requirement divided by assessment equals the tax rate. So using nice round numbers in a municipality that charges the same tax rate to all of its assessment classes, as an example, the municipality has determined that $1 million is required to cover the operating and capital costs, minus other revenue sources such as grants and user fees. If their total assessment base is $100 million, they will need to apply a tax rate of 0.010. Some people may be more familiar with the term mill rate, which is how old legislation used to refer to it. And the mill rate is calculated by simply multiplying the tax rate by 1,000. So in this example, the mill rate would be 10. However, you won't find the term mill rate in the most current version of the MGA, but we often see some municipalities that like to hold on to that outdated term. Again, before the tax rates can be calculated and applied, Council has to approve the operating and capital budgets required for the upcoming year. If your council passed an interim budget before the end of last year, the final budget would have to be passed in the early part of this year. So which is the only part of this equation that council has control over? So council can't change the assessment values determined by the assessor, and the tax rate is simply the budget required divided by the assessment. So the only portion council can effectively control is the budgetary revenue requirement. During the budget discussions, administration must ensure council is aware of the effects the proposed budget will have on tax rates. This is the appropriate time for this discussion, and not the day you are hoping council passes the tax rate bylaw. The preparation time leading up to the passage of the final budget is when you are going to want to present example assessments, tax rates, and resulting tax bills to your council to reduce any sticker shock councillors might feel if they are passing the tax rate bylaw with much higher rates than the previous year. If council decides the tax rate resulting from the approved budget would be unacceptable, then the budget must be revised to reduce the expenditures so that the revenue requirements are lowered enough to produce a tax rate council can live with. If budget reductions are made, council must specify what programs or services will be reduced, and not simply ask administration to cut a certain dollar amount or percentage, as council is responsible for setting the budget, not administration. The only policy decision left at this point is how the burden of the budget requirement will be distributed among all property owners and assessed persons. But first, let's look at assessment classes and subclasses a little more closely. Currently, there are 4 broad classes of property assessment set out in the MGA. These are important because the assessment class or subclass determines the tax rate that will be applied to each property, as they can have different tax rates per Section 354. So Class 1, which is residential, can be subclassed by bylaw to any extent that council considers appropriate, and this is per Section 297. Some common examples of this are vacant / improved and multifamily / single family dwellings. The municipality should be prepared to explain and justify any differences in tax rates for residential subclasses. For example, there may be different service levels in hamlets versus country residential properties that could warrant a difference in tax rates. Or council may want to incentivize development on vacant properties by charging a higher tax rate for that subclass. Then we have Class 2, which is non-residential. So this includes both commercial properties such as stores and businesses assessed by your local assessor, as well as linear properties that are considered designated industrial property, or otherwise known as DIP, which are assessed by the provincial assessor. And these can include pipelines, railways, oil and gas wells, and electric power and telecommunication systems. Non-residential can be subclassed into either vacant, small business, or other non-residential. The matters relating to assessment subclasses regulation, which you might hear of as the MRASC, further defines the requirements around properties qualifying for the non-residential subclasses. With the Bill 21 amendments that were approved in June of last year, all the provisions of this regulation will be eventually included right in Section 297 of the MGA, but we have not been advised of exactly when that will happen. And then we have Class 3, which is farmland. And then Class 4 is machinery and equipment. And this class is used in conjunction with properties such as meat processing plants, refineries, chemical plants, pulp and paper plants, and oil sands plants. Most machinery and equipment is assessed by the municipal assessor. However, machinery and equipment that is part of designated industrial property is assessed by the provincial assessor. Currently, these last two classes cannot be subclassed any further. Additionally, one or more classes or subclasses may be assigned to a property. A commercial building could have a residential component as the living quarters, for example. And before an assessor can apply subclasses to the residential and non-residential classes, council must pass a bylaw setting out which subclasses they want to use. Since the assessment roll is required to be prepared annually by February 28th, this bylaw should be passed or amended well in advance of that. So back to the only policy decision left after council has passed the budget, which is how the burden of the budget requirement will be distributed among all property owners by imposing different tax rates on classes and subclasses. We're going to show you a couple of real-life examples of this policy decision that has made the news quite recently. So the first example is the City of Calgary. And there, the Chamber of Commerce was lobbying for the city's business owners to bear a lighter load of the property tax burden before the budget was passed late last year. So currently, residential property owners bear 52% of the total tax burden, while non-residential property owners bear 48%, while making up only 20% of the total assessment. And this came to a more recent City Council meeting where the Chamber of Commerce wanted the city to carry out a 2% shift away from non-residential each year for the next 4 years. So that ask would rebalance the burden to a 60-40 split, which would increase the tax burden for residential property owners. But at the end of the day, the council decided to stick with the status quo. And then the other example is in the city of Edmonton. And for around 50 years, the city had a separate residential assessment subclass for rental properties with 4 or more units with a higher tax rate compared to other types of homes, specifically condos. But they have recently decided to remove that subclass, so all homeowners will have to bear the burden of the premium rate apartment owners used to pay. So to reiterate, the MGA allows for different tax rates for different classes and subclasses. However, Section 358.1 creates a stipulation in the way of a maximum tax ratio between non-residential and residential tax rates, which is 5-to-1. In other words, the highest non-residential tax rate cannot be more than 5 times the lowest residential tax rate. Another limitation set by the MRASC related to the non-residential subclass, the rate for the small business subclass must not be greater than or less than 75% of the rate set for the other non-residential subclass. And then we have Section 357 is another important section to be aware of, and it allows for a minimum amount payable as property tax. So if a municipality wants to ensure that each tax bill covers off the minimum costs involved with each property, such as costs for processing and mailing the tax and assessment notice, it could set a minimum amount payable. It's important to remember that a minimum tax must apply to all assessment classes and subclasses. So in other words, you can have different minimums for each. The additional revenue gained when a minimum tax is applied must be reflected in the budget. And Jordan's going to discuss that a little bit further when he looks at the case study with you. And then finally, we have Section 357.1, which is a tax rate for residential. So residential tax rates must be set above 0. And some people might ask why that is. And because of the maximum tax ratio that I talked about earlier, the 5-to-1. And we all know that friends don't let friends divide by 0. All right, so looking at requisitions, which is going to be another part of your tax rate bylaw. So requisitions are funds collected by municipalities through annual taxation on behalf of the provincial or regional programs shown on this slide. Only requisitions recognized by the MGA are permitted to be included on the tax rate bylaw. So the only three requisitions recognized in Section 326 of the MGA are the Alberta School Foundation Fund, or the ASFF, the Seniors Housing Requisition, and the Designated Industrial Property, or DIP requisition. Your municipalities will be sent lovely polite letters advising you of the amounts your municipality has to contribute to these provincial and regional programs. Just remember that requisition amounts are based on equalized assessment determined by the province, not the assessment values determined by your local assessor. This slide also shows to which classes these requisitions are applied. So the ASFF applies to residential, non-residential, and farmland. Seniors housing applies to all classes. And the DIP requisition, which is the province's cost to assess these types of properties on behalf of municipalities, only applies to DIP properties. The DIP requisition rate and the amount owed are provided by our ministry, and the same rate is applied to all DIP properties province-wide. With respect to requisitions under Section 359 Sub 2, municipalities have the ability to establish a rate to recover the amounts they believe will be uncollectible. This is to help the municipality meet their requirements to pay the full amount of the requisitions, even when they don't necessarily collect them from every individual taxpayer. The rate for this allowance cannot exceed the actual rate of non-collection in the previous year. Also, more of an audit function, but each year your auditor will identify if you have over or under levied with respect to any of the requisitions, and then provide the appropriate increase or decrease that will have to be adjusted for on next year's bylaw. So these differences are usually the result of changes that the assessor makes to individual assessments under Section 305 throughout the year. And these are based on errors or omissions they find or issues raised by property owners. There is no requirement to show this amount on the bylaw, so it can be included as a budget item. Just want to point out that policing is not on this slide because there is no legislative mechanism to treat policing costs as a requisition. So they have to be included in the budget as an expense and will affect the general municipal tax rate. But if council wants taxpayers to know how much of their tax bill is going toward the cost of policing, there could be an informational brochure that is sent out with the notices showing a breakdown of how much of each tax dollar goes where. So the next two slides I have show some important questions that need to be asked while preparing the tax rate bylaw and printing the tax notices. These questions are based on common errors that are picked up by our MAP advisors when they review municipalities and from our information services folks when they receive the annual financial information returns. So yes, these questions are based in reality, not my overthinking brain dreaming them up. First of all, has the final budget been approved by council? As I had discussed earlier, the expected revenue and expenditure amounts set out in the approved budget must be used to determine the tax rates that need to be applied to the municipal assessment. There could be some risk to the tax rate bylaw being challenged if the tax bylaw was passed before the budget was approved. Speaking of assessment, it's important to make sure that the assessment numbers balance before the tax bylaw is passed. So what I mean by that is that on the day the tax rate bylaw is passed, your assessment file must balance to the assessor's file, and both of which must match what the bylaw shows for assessment values. This is because the assessor may have had to make changes to individual assessments under Section 305 after providing the assessment roll to the municipality in January or February. So you must ensure that the assessment totals in the bylaw also reflect these changes. Another question to ask, are all the calculations on the tax rate bylaw correct? Sometimes numbers from your spreadsheets don't get transferred over to the bylaw properly, or maybe there was an error in a formula that went undetected. So we recommend getting a second or third set of eyes that aren't involved in the bylaw preparation to check the calculations on the final bylaw with a good old-fashioned calculator. It's surprising how many bylaws have been found with math errors. And just a reiteration of making sure you don't have any requisitions in your bylaw other than the 3 I talked about a few minutes ago. We've seen municipalities include requisitions for fire protection and recreational services, which is not legislatively compliant. Instead, the costs for these services need to be included in the budget, or perhaps they could be imposed using a special tax bylaw instead. You also want to make sure the amount your auditor has identified as an over or under levy regarding your requisitions from the previous year has been carried into your current budget year. And Jordan will show how that works in just a minute. A few other questions. It might sound a little bit obvious, but especially when you use the previous year's tax rate bylaw to create the current one, it's easy to overlook the dates while focusing on the numbers. So make sure those dates also get updated properly. And as I had mentioned earlier, only one minimum tax is allowed to be applied to all the assessment classes and subclasses. Another common issue we often see is the current year's bylaw rescinding the previous year's bylaw, which you do not want to do. Coming into a new tax year does not mean that the previous year's taxes are forgotten about, so you still need the previous year's bylaws to authorize the ongoing collection of those taxes, even potentially through tax recovery. It's important to remember section 358.1, which is the 5-to-1 ratio, and make sure your tax rates comply. Also, if you have a non-residential small business subclass, it needs to comply with the MRASC regulation, the provisions of which will soon be found in section 297 of the MGA. When you're developing the tax rate bylaw, it's a good time to review the tax penalty bylaw as well. This is to make sure what is going to be printed on the tax notices is consistent with both bylaws. So maybe there were changes made to the to the tax penalty bylaw to allow for later payment due dates because of COVID. So was this done by a sunset clause in an amending bylaw that has now expired? Or are there other changes necessary to reverse those measures that were intended to be temporary? Another question to answer is whether your penalty bylaw is explicit in that penalties are calculated on penalties, because taxpayers often question that, even though section 346 of the MGA states that penalties become part of a tax. And speaking of tax notices, hopefully you'll be taking some time to do some test printing to ensure software updates haven't messed up anything since last year. You'll want to print a good sample of notices, including notices with every assessment class and subclass, and ones that have multiple owners or multiple classes to make sure the spacing is still correct. All the necessary fields show up and the calculations still work properly. So those are the most common issues we typically see with tax rate bylaws. And now I'm just going to talk a bit about what the process is if a significant error or omission requiring a redo is discovered after the bylaw is passed and the notices have gone out. So section 354 of the MGA requires the bylaw to be amended by council, amended tax notices to be sent out, and the ministry to be provided with a copy of the amended bylaw within 30 days. So it's not a process you really want to go through if at all possible. So it would be wise to take the time and energy to double and triple check everything to avoid having to take these extra legislated steps. Now it's time for a segment we like to call Fun with Assessment and Budget Numbers. So this will give you an opportunity to apply the information I've just talked about by working through a case study. You may have had some time to complete it in advance, so Jordan will walk through what we consider to be the right answers.
Hello, and thank you very much, Angela, for a wonderful presentation. And hi everyone, and thank you for attending. My name is Jordan, Municipal Financial Advisor, and I will be walking you through a case study. So let me share my screen here first. There you go. And I hope everyone can see that. Just organizing myself. All right. So this is a case study that we updated. It was a previous one, but we updated the numbers and we provided some tips and more current information. So I'll go through this with you. This is a case study here, will be posted online, and this is the sample tax rate bylaw. So this is a case study about a municipality called the Town of New Sampleford. It is a simplified case study intended to review the process for the development of the municipal tax rate bylaw and contains all the information required to build a 2005 tax rate bylaw for the Town of New Sampleford. So we're going to walk through. So the first thing we're going to start off is we're going to review the operating budget summary. And these are some of the core or most commonly used items. You may have different ones, but these are some commonly used. So we have the total revenue. We have the net municipal revenue, which we can find out this number coming up, but we put in some numbers. We have the revenue received from minimum tax, Angela mentioned, and then we have expenses and amortization. So and these are all operating items. So you take your total revenues, 855, minus your total expenses, and then we're going to add back the non-cash item, which is amortization, and you get 1271. So as I mentioned, this number here, if you take this as 1271 plus 855, you're actually going to equal 2526. So track 400, and those will be the same. So we are going to go to the next one, which is the capital budget. So the capital budget are meant for those larger long-term capital purchases. So for the revenue, we have the government transfers for capital, which usually received from the province or the federal government, and the reserves used for capital, which we would transfer ourselves. And then the expenses, so the actual capital purchases. So that could be road construction, water treatment plant upgrades, very common, or purchasing public works equipment. So we get total expenses. And we want to know what the difference is, and that's how much we are going to have to collect from taxes. So we have our pre-tax revenue, our pre-tax capital expenses. Difference is 150,000. And that's number we're going to keep track of to collect. We have our additional cash requirements. We may have some debt payments on loans we have outstanding for $100,000 this year, and amounts we're going to maybe transfer back to capital reserves for future year purchases. Oops. And that comes to a total of 175,000. So now that we've kind of gone through the operating budget and the capital budget, we're now going to implement some of these numbers into our tax rate bylaw. So this is a sample tax rate bylaw. Well, this is whereas for the year 2005. So a bylaw to authorize the rates of taxation to be levied against accessible property within the town of New Sampleford for the 2005 taxation year. So, whereas the town of New Sampleford has prepared and adopted detailed estimates of municipal revenue, expenses and expenditures are required at the council meeting held December 31st, 2004. So tip 1, council must adopt an operating capital budget, and this refers to section 242, 245, or an annual budget, which is section 248.1, by January 1st of that calendar year. All right, so whereas the estimated municipal revenues from all sources of municipal revenues other than property taxation, so this is taxation, so other than that one was 855. So we're going to put 855 there. Whereas the estimated municipal expenses, including non-cash item, set out in the budget. So we know that this is your total expenses, excluding non-cash items, which is the amortization. So we're going to do equals 2526 minus 400,000. Gets you that number there. The balance is raised by general municipal taxation. So this number of 1271 would go right there. However, we're going to continue. Whereas the estimated amount required to pay principal debt raised by general municipal taxation comes from the capital budget, or additional cash requirements, I'm sorry, is 100,000. So 100. And the estimated amount required for current year capital expenditures raised by, so it would be this one here. Current year capital expenditures is a difference between the money we have coming in and the actual expenditures is 150, because this is the additional cash we need from taxes, the additional revenue from taxes to pay for that number. So we put 150,000. And then the amount required for transfers to capital reserves for future purchases in future years. Remember that was 75. So put that here. And then we get final number. Therefore, the total amount to be raised by general municipal taxation is 1596. And this is kind of a brief formula of the calculation below. Total municipal taxes required equals expenses, which we have. Oops. Sorry, I just wanted to show you. Okay. Expenses minus the revenue plus the debt payments plus the capital expense and plus the future savings. And that gets you that number there. So now we're going to proceed further in the case studies. So we're going to look at the requisitions now. The requisitions in the case study are Alberta School Foundation, which consists of residential and farmland, and under levy, which I'm going to talk about, and non-residential, Seniors Foundation, and DIP. So we're going to enter these numbers in, and then we're going to read the tips. So residential and farmland we see is 210, 500. We see the under levy is 10. We see the non-residential is 94, 500. And allowance is 0. We'll leave that as 0. We don't see anything there. The dip there is 745. And the Seniors Foundation is 21,500. Hopefully I read all those correctly. Okay, so going back, a municipality may include an allowance for non-collection of taxes, which is section 359. So that's why we got this one here. I'm going to skip the 3. A municipality may choose to show an under or over levy in the requisition section of the tax rate bylaw as a separate item or include as part of a main requisition. So here we chose to include it as a separate line item. However, if you want to include it, you can include it as part of residential or part of non-residential. But we chose to include it as a separate item on residential farmland. So how the under and over levy works is there are chances your municipality may see a change in assessment that could cause an under or an over levy. But for example, a decrease in assessment would cause an under levy, which would cause the municipality to for the need to collect more taxes the next year. So for example, when an assessment decreases, less municipal taxes can be charged, which ultimately creates a budget shortfall in the collection of taxes, causing the under levy, in which more taxes need to be collected in the next year to make up for the difference. And the opposite can be said for an over levy. So continuing on the tax rate bylaw here, as Angela mentioned, these are the three main requisitions. Alberta School Foundation, and this is provided by Alberta Education. Designated industrial property, provided by Municipal Affairs. and a seniors foundation provided by the related Seniors Housing Foundation. So now that we've entered that, we are then going to go back. We're going to go back to the case study now, and we're going to look at the assessment information. Just want to keep organized. So the assessment assessment information. We see residential. Residential has a subclass shown. Farmland, non-residential small business, machinery equipment, and designated industrial property. So, whereas the council is authorized to subclass assess property and to establish different rates of taxation in respect to each subclass of property, subject to the MGA. So, whereas the assessed value of all property in the town of Sampleford shown in the assessment roll, and we're going to input these numbers. So this is residential and farmland. So we're going to input residential there. 90, 203 plus the farmland, 631. Perfect. We're going to input the residential subclass, which we see as 5. The non-residential, 15. The non-residential small business, 5. The dip there, which is 972. And the machinery and equipment. Okay, so tip number 6, municipality may by bylaw establish a small business subclassification. Oops, right there. For non-residential assessment, and that refers to the Alberta Regulation 202, 2017 matters relating to assessment subclasses regulation. So tip number 7, the designated industrial property, that one, is not a major assessment class, but is included in non-residential and or machinery and equipment assessment classes. However, we show the dip here for requisition calculation purposes. However, the dip is included as part of non-residential assessment, just to keep you aware. We should start there. Okay, so now we are going to we're going to continue on in the case study and read the last portion here. So in 2004, the Council of Town of New Sampleford adopted a policy regarding the proportion of municipal tax revenue requirements to be derived from all assessment classes to provide consistency for administration when preparing the draft tax rate bylaw. Below are excerpts from that policy that will help in developing a 2005 tax rate bylaw. So, the division of tax revenue collected from residential and non-residential, residential being 70%, non-residential being 30%. Of that 30% of the 70% of residential, 90% are collected from residential, 10% residential subclass. Of the 30% of non-residential, 88% collected from non-residential and 12% collected from non-residential small business. It's also going to know that the municipal tax rates for residential and farmland will be assessed. Farmland assessment will be equal. The municipal tax rates for non-residential machinery equipment assessment will be equal. And allowance for non-collection of taxes is 0. So we put that up there already. And the minimum municipal tax for taxable properties will be 500. So we've noted all of that.
Yeah.
So we're now going to continue the tax rate bylaw. So, the Chief Administrator is hereby authorized to levy the following rates of taxation on the assessed value of property as shown on the assessment roll of the town of New Sampleford. So, residential and farmland. So we know that residential and farmland is 70% of the revenue required, and then of that it's 90%. And versus the 10% is the residential subclass. So we are going to do that. We're going to find out how much the levies are going to be for these items to make the budget ultimately. So we're going to do equals, and I create a little allocations tab here. So this is the amount to be raised by general municipal taxation, which we know. We're going to multiply that by the 70%, like in the case study, and times by the 90%, like in the case study for residential. We're going to press enter. And that's the amount tax levy we need for residential farmland. That's the assessment from up above, 9831, and then it computes the tax rate accordingly. Do the same thing with the others. Equals total amount raised by taxation multiplied by 70% because it's residential. However, this is a residential subclass. Residential subclass, 10% equals non-residential machinery and equipment will be non-residential. This one, 30%, and 88% non-residential. This one here. So we're going to do equals, back to the allocations tab, right there, 30% times 88%. And for the last one, we know that the small business is 12%. 12% of the 30% of non-residential. So we're going to do the same. 30% times 12%. And this number here, we know at least it's correctly so far, the 1596. That's the same as the number shown above for the total amount to be raised by general municipal taxation. So we know how much we're going to levy. The assessments are all there. Note that the assessment for non-residential machinery is the non-residential plus the DIP plus machinery and equipment. So you can see here, non-residential plus a DIP plus machinery and equipment. We get the residential tax rates, the non-residential tax rates. We have tip number 8. So section 297 establishes 4 major assessment classes, as Angela mentioned: residential, non-residential, farmland, machinery and equipment. And section 354 authorizes different tax rates for each assessment class, as we have. As we note, we do not see DIP. We include a DIP right there, non-residential machinery and equipment. Tip number 9, the highest tax rate for non-residential properties must be higher, or the highest tax rate for non-residential properties must not be higher than 5 times the lowest tax rate for residential properties. And Angela mentioned this as well, section 358, and we're going to do a brief calculation right now. So we have the lowest residential, which would be this one. We have the highest non-residential, which would be this one. We simply divide one by the other. We get 1.3 less than 5. We know we're okay. We also know that from tip number 10, machinery and equipment has a 0 tax rate for the purposes of Alberta School Foundation, which we'll be showing soon. So tip number 11A, Alberta regulation. Matters related to assessment subclass regulation also states that small business property may not be less than 75% of non-residential properties. We're going to do the math for that as well to make sure that is true. We have the non-residential small business rate, which we got right here. And we have the non-residential rate, which we got here. Small business rate must not be less than 75%. Simply divide 1 by the other, and we get 80%. So we're above 75%. So we satisfy that condition. So just something to be aware of as well. Now we are going to continue. So this is the requisitions, Alberta School Foundation. We broke it down into residential farmland, non-residential allowance for non-collectible taxes. And remember the allowance note from above for this one here. Designated industrial property and seniors foundation. Here, this 2,500, unlike above, we included the under levy of 10,000, because if you recall from the case study, the requisition of Alberta School Foundation residential farmland was 210. We included the under levy of 10,000, and that's how you get the 20,000 there. This number here is the residential farmland plus the residential subclass. And then for this one, this is the non-residential plus non-residential small business plus a designated industrial property. And we got the tax rates for the requisitions. And then also to note is the designated industrial property tax rate, which is given to us. So we simply just have to input it here. And we can, in tip 12, the provincial assessor will provide you with a tax rate to charge for the DIP requisition if you have DIP properties municipalities. So that's where it comes from. For 2022, the provincial assessor has provided a tax rate of there's 1, 2, 3, 4 zeros and then 766, and that's one that everyone will use. And from there, because you get this, you know this, you actually work backwards, and that's how you calculate your tax levy for DIP. And for the Seniors Foundation, they use the total from above and seen there. So the DIP one, you kind of work backwards. Tip 13, municipalities are required to set the same local school rates for ASFF and separate opted out school board supporters for each class of property. And this is per section 160, number 2B of the Education Act. Under ASFF, Alberta School Foundation, municipalities may choose to have separate line for under and over levies, as we mentioned above, or can include it within the existing requisition. Here we showed we included it. And the under levy above is included in residential farmland. Perfect. As Angela mentioned as well, that there's a minimum tax here, which is 215. The MGA allows for only one minimum tax rate, section 357. And that's revenue generated from minimum tax must be included in the budget and shown in the property tax rate bylaw. So we show it in the property tax rate bylaw, and we go back up to the operating budget, and we can see that it has been included revenue received from minimum tax. And this is just the remainder, and that's everything I have to share regarding the case study. I hope you guys enjoyed it, and I will pass it back over to Angela.
Thanks, Jordan. So I hope everyone found that information beneficial, and working through the case study really helps you get a handle on where things actually need to go in your bylaw. So hopefully if you have any questions or if you're stuck on anything, certainly give us a call or an email. So our phone number, our main line is up on this slide, and our email address has changed a little bit recently. So you want to make sure you update your contact information to that email address. And there's a couple of other resources on this slide that you might be interested in reviewing. Again, if you have any questions, please reach out to us and we can certainly try to answer any of them that you have. And that's basically all the information we have. So hopefully you again find benefit from this information, and we hope that your tax season goes well and without many problems or issues. So again, we're more than happy to speak with you about any of this information. So thank you so much, and I hope you enjoy the rest of your day.
Thanks. Have a good day.